Well, hello and welcome once again to another lab. Today we're going to do a straddle. A couple of things I wanted to bring up with this class is, the application is a lot different when it comes to kind of the theory and the methodology of it. There are ways to set this up with exceptions before it's implemented. And what I mean by that, folks, is it's like, let's say, and the example that I got here is, let's say that we don't have that, 2 weeks out, or let's say that it announces tonight. That's what I have here. There are different things you can do when it comes to implementing not only just the straddle, but any options strategy on any certain position. Meaning, okay, if we do it super short time, we are going to limit ourselves to the amount of management or the choices of management we can use. This is good. It's totally fine. The idea is to make sure that the management is in place before the position is entered. Now, guys, I'm going to give you my 2 cents on this. This example is probably going to be obsolete by the time you get through this class, so keep that in mind. Whatever you decide to get from this course or follow along with, take responsibility for the outcome. You got to have a plan first. Otherwise, none of this will work. So let's jump into my Thinkorswim here. So the first things first. First thing you want to find is an event. Straddles and strangles are not my strong suit, meaning I don't use them as often as other combos, but they can be really cool, especially if you want to do something. There's a couple ways to look at it. A big explosion, an increase in volatility, because that's what this is for. The straddle and strangle is designed for volatility increase. It's basically taking the volatility that is built into the combo itself, and we are betting on the over. We expect it's going to go more. And what we mean by more is volatility is going to increase, or the range is going to exceed the cost of the straddle strangle. This you know. And if you don't, please revisit the Straddle Strangle courses. So we're in the situation where I like to put it on earnings. Earnings are the easiest. They're the easiest to calculate. They're the easiest to see that's coming, so on and so forth. There are times where you could have sectors have huge pushing pull, and you could have events, things that are happening in the markets. But when the markets are kind of boring or dull, or they're moving up or down, so on and so forth, it's much easier just to find an earnings event. So I found this on Lulu. It announces this afternoon, so I think it'd be kind of really cool. So let's keep in mind that this is going to announce very quickly. So the first thing you want to do is see if this is a feasible trade, right, guys? Before I get to it, I want to make sure that we jump back and forth, because I do have our fillable worksheet. So the first thing we're going to do, let's see if this is types. I wasn't sure if it was going to work. Sometimes when I download them, folks, and you guys might have had the same situation, is sometimes they don't fill. That's easy, just do them online. Okay, the date, today's the 30th, but, it announces this afternoon. So the 31st would actually be the next day that we could trade this. Understand that when the bell rings, we'll see a whole bunch of movement, but when tomorrow morning opens is where we can adjust this. But it does announce tonight. So high or low base, it does. We have kind of a base right there, or I'll call it a base. Let's go back to it and make sure that I'm doing this. Yeah, I like this base here, or, well, I guess we could call it kind of an ascending triangle pattern. But what's really neat about this, let me see if I can get a straight line, is it does kind of correlate with some support and resistance areas back in the day, right? Support, a little bit of a resistance here, set this low. Now it's kind of a consolidation. I'll call this a base. Doesn't have to be a base or a high base, low base, but we're looking for something where price action is kind of staying in an area because it's about ready to explode. Now, just on charting, guys, we've got targets all up through here. We got a down target here, so on and so forth. We're not going to use these quite yet. What we're going to do is we're going to take the at-the-money straddle. I'll show you how we could do it quickly with Thinkorswim. But like other places that you might trade that doesn't have that, all you do is you just take the cost of your straddle, and that cost is actually directly in relation to the time that you're purchasing it, how far out you are, and the current volatility and the expectations of the move up or down. So it's kind of cool, guys, because if you don't have what Thinkorswim does, which is the plus minus here, I'll show you in a second, you can do this by literally just building it and seeing what the bid-ask spread is for the cost of the trade itself. It's kind of cool. All right, so we know what we're looking for to this point. Let's jump back to our straddle chart here and see if we can't continue to fill stuff out, or else go through our checklist. So I'm going to call that a kind of a low base or some sort of a basing system. We want to buy to open the closest strike prices to the current stock price. That's going to be easy. I think this thing's right around $320. Let's get back to it. Work through this. 317. Maybe there's a 317 and a half, which I believe there is. So I'm going to go ahead and analyze this, and let's take a look at our first area here. So we can see this is definitely expecting. Let me get a more colorful pen. Definitely expecting something, as the fact that today's volatility is 84, and then we go to the 50s and down. So this is the plus minus that I'm talking about. And what this does is it gives you the direct volatility for the expiration cycle that you're looking at. And this is kind of cool. Now what I want to do, and this is going to be neat, we're going to do standard. We're going to go 2 weeks past the announcement date. I'm also going to do the day of. And what this is just a simple absolute gamble coin flip. This is going to be something a little bit more specific to the call and put ratio back spreads. Something that's very aggressive. So I'm going to do the aggressive way, then I'm going to do, I'll do both. I'll do the setup sheet first, folks, then I'll do the aggressive way just to compare and contrast. Okay. Now, if you don't have these numbers, because this is the expected move, plus minuses, the expected move for the expiration cycle, just by putting the two together, and you're going to see this, the cost of the straddle will dictate that as well. So you can find it in a couple different places. Just neat to kind of look at it on the right side there, because without having to go through and build both of these separate combos, I can make the decision, do I think this thing's going to be about $19 or do I think this thing's going to go about $28? And then you can play it from there. Remember, management will be different. So let's walk through our base scenario, which is let's buy a couple of weeks past the event, which is going to be tonight or today. So we got a 317 and a half, and the stock is currently trading about 318. That's about as close as we're going to get. So I'm just going to go straight to it. I'm going to go ahead and buy the 317 and a half puts, and I'm going to hold down my control key with thinkorswim and buy the 317 and a half calls. You see down here it built my straddle. I'm going to knock this down to 1 because this thing's going to be super expensive. And notice here, guys, our cost is $28.20. And let me get my little bad boy here. Where'd my pen go? There it is. $28.18 or 20 cents. Look how close this is. In fact, it's right on currently. So there's no real leverage here with the expected move and the cost of the combo. Which, if it's priced correctly, and you saw that the price just dropped down to $27.68, expected cost is $28. Now, the idea is this. It's going to move to at least that point if we're 2 weeks past, and based on our management, which we're going to get through in the chart here. Remember, management, you just came off the management class. You can get rid of the call or the put, the one that's hurting you, and hold the remaining direction and let it go further, further, further. There's that side of it. Or you hold the whole combo, let it go 3 days past to see if it can continue higher or lower, and sell the whole combo. So the management strategy, remember, with this is if you're going 2 to 3 weeks past, you're going to allow yourself further gains past the explosion event. Now, there are times where we can just take advantage of the explosive event, and that's it. So when we start talking about April 1st expiration, in this case, it's only 2 days out. Now, folks, real quick, before I get 1,000 questions, this is Easter weekend is coming up. This should be 4 days, but it's 2 days because of Good Friday. So Friday is, the markets are closed. So technically there's today and then there's, today, tomorrow, and Thursday. So 2 days from today is where this will expire. So I'm going to have that question. I know it. So this should say 4 because, of the dates, because it's the 30th, but it's only 2 because it counts today and then Good Friday, the markets are closed. So we only got 2 days. There's an advantage to that though, right? 2 days, it should be cheap. Wait for a big move. We'll go from there. All right. So let's continue on with our trade. So $27.73 is roughly what we're going to play with. Let's go back to our worksheet and see what we can and can't do. There we go here. All right, so we're going to buy to close. We found that 2 weeks past or more. That's fine. We got a stock with a beta 1.5. That's obvious. Folks, I didn't go too deep into it. I just skipped through the charting part of it. But Lulu's pretty aggressive. It's pretty easy to do. Just do your charting analysis and you'll find that. Stock volume, yes, that's also doing the top down. So our time frame. Our time frame is going to be, let's go 3 days past, and I'm going to go 3 past. I do it that way. I think it's kind of fun. So time frame is 3 past the announcement date. Entry is now. I'm just going to put, just to make a note, 317.50. That's what I'm going to buy here. Now stops, none. Targets, we got to come up with a target plus minus. So stops, I'm going to put, oh gosh, well I could actually put it down here, but you guys can see that my stops are down in the trade management. After 3 days, I'm out. If it's greater or less or greater or equal to 10% of a gain, protect the combo up or down, so on and so forth. So the stops are actually in there. Targets, you're going to have 2 targets. Let's go ahead and do the math there. Let me get my phone out. I do not have a calculator handy. And we'll play this game. Let's see here. My calculator. All right, let's go back to our Thinkorswim. And from 317.50, we're going to add $27 to it. 317.50. I'm going to add 20. Let's add $28 just to make it even here. Plus 28 equals 345.50. Let's go back to our chart here. 345.50. Oh, that's not going to fit, is it? Maybe it will. Let's see if I can get it all crammed in there. I don't think I can. If not, I'll just write it. So then we go back and take into our account this 2770. I'm going to go from the 317.50 and I'm going to minus, right? We minus it to the other side. Let's go 28 to keep it even. Equals 289.50. I don't think it's going to fit, but let's try it. Nope, it's not going to fit. So I'm just going to write it out here. How's that, guys? Let's see if I can do it this way so I don't lose it again. 289.50. 289.50. All right, so we got our break evens. I won't do it because, sorry guys, because if I do, every time I hit erase on the button, it's just going to erase it. So 289.50, and then I'll do that other one again here. So, moving on, let's get to the cost of this thing. So, let me put in the expiration dates for this, and our targets, so on and so forth. I try to fill these out as realistic as I can. 16th of April. Right, yeah, okay, 16th of April, 4/6, yep, 4/6, this is going to be the strike price of 317.50. It's kind of funny how we have buy to open in both. It should be the same price. Okay, so now we have to deal with our costs and our position sizing. Now remember folks, management styles, these are too expensive. We don't want to buy these bad boys all the way. So we don't want to risk the full amount. We're going to do it by either 3 days out with a 30% volatility crush. That's kind of where we at it. You can actually do 50% risk if you're going to be the guy that wants to carry it past 3 days, meaning, if we've got a 50% risk of the whole amount of the trade, then you can let this thing go past 4 or 5 days, 6 days, whatever you want to do, and follow it up or down depending on where it gaps. So remember, both those are in the management. So here I'm going to do something. I'll do 30% and after 3 days, because 3 days past is what I put the time frame for the target as well. So keep this in mind. So let's do this. Let's jump back over to this and find out where we're at. Okay, let's get our risk profile out. And you can see that I've already got the volatility step out. So the first thing we'll do is let's take a look at, I want to start it over here so you guys kind of know where we're at. So this is kind of the first view you're going to get. This is today, and then at expirations down there. You guys can see that if I put my mouse over here, that's $2,600. No, I don't want to list, or the $2,700 is what it would be after it expires. I'm not going to do that. We're not going to keep it anywhere near the expiration date. So let's do a couple of things. The first thing I want to do is our vol step. And I'm going to do 4 different stages with this. Now I expect a 30% drop in volatility. Now I could switch this to 30 and just count the front line, but what I like to do is drop it by 5s. So I know just visually the first drop is going to take it to 45, the second 40, and the third 35, so on and so forth. Now, if I'm expecting 30%, I might want to do these in $10 increments. Oops, let's go ahead and do it in 10. There we go. Then I can go down. Here's 10, here's 20, here's 30. So it's the pink line that I'm going to be focusing on. So I'm going to go ahead and just kind of hover the mouse right around that 317 mark, and I know that, okay, that's about $1,100. Okay, it's about 50%. Well, that's a little less than 50% of what's expected in the loss just with the volatility crush. Okay. Now the other thing I can do is this: add a couple of days. Now when I add these days, it gives me a range. And what I do with this, let's see, let's go 1, 2, let's go 3 days. Okay. Remember, the markets are actually closed on the second, but so I'm going to have to drop one more. There we go. Let's go back. So what I do is, this is kind of the range that we expect this thing to move. Remember, we had an up and a down break even. 289.5 was to the downside, right? And you could say it's just shy of that. And the upside was 317 plus the cost. So it's not quite there. I think it was 345, wasn't it, guys? 345. I'll have to do that math. I erased it before I wrote it down. What do you know? So this is the expected movement. So that's kind of where I do with the few days. So it's like, okay, I could expect a loss anywhere from $900. The worst would be that $1,100. Yeah, about $900 to $1,100 if it's somewhere in this range. Now that's as good as I can get. Now understand, folks, it's going to be somewhere in there. It could be past it, it could be below it, but it probably won't be more than, unless the volatility drops 60% or 70% or so on and so forth. But we can also, right here, take a look at it. So the pink line is 30%. 40% would be the blue line. Let's take a look at that. That's $1,600. So we lose another $500. So it looks to me it's about a $500 drop per 10% drop in volatility, if you take a look at all of those. Kind of a fun way to do it, right? It's an easy way to gander. Understand that these are just based on what's in front of it. It has no idea what's happening in the future. It's just the current volatility, the current breaks, current everything. So the best I can muster is the fact that, hey, I'm probably risking anywhere from $1,100 to $1,600, worst case scenario, if this thing goes nowhere. Now, once again, if it goes up a little bit, I may lose substantially less. If it goes down a little bit, I lose substantially less. Now, the idea is for us to go way past. So I take into consideration kind of the worst case scenario, but I want to make it even. I don't want to like go super, super worse, but might go a little bit, like I say, that pink line. So I'm just going to call it about $1,150 for my risk. Gains on there, I'm just going to put unlimited. If I can know how to spell it. And then the max loss is that $27.70. But I'm putting it in there just to remind me that I would have to really, I'll call it 50 cents, really mismanage this bad boy to have that happen. So that's it. Net cost is going to be, let's see where the bid and ask get. I could switch my mask risk while I'm there. $27.05. Cool. So it's gotten a little bit cheaper. So let's change these numbers so they match. 27.05, and that's going to be, it's about right. Just get rid of that 1.7 if I can. Oops, not a nice line. Sorry, guys. I'm fumbling around a little bit. There you go. How's that? That looks about right. Okay. So there's kind of the breakdown of what we could expect to do. Now the stops, you could put those in as well when it comes to, exiting. I don't want to call it a stop. It's going to be an exit. We don't want to stop. We want this thing to explode in one direction or the next, and we'll go from there. So there is our first scenario. Let's go take a look at. Let's see. Am I missing anything? I don't think I'm forgetting anything on this. No. So there's our ideal. The expectations are plus. Ooh, let's take a look at this bad boy on the chart. Now I'm going to go ahead and redo my math since we're here. Okay, 317.50 minus, let's call it, it's now down to $27. So it's kind of hard to do this on the fly, right, guys? Because it goes up and down. We're in a live market. So it's now at $22.90. I'm just going to round it off to the upside. 317.50 plus $27 is $344. 50 to the upside, but I'll call it 345. We'll do that. Okay, so now I've got some things to look at when I get to the chart. This is what I like to do with these as well. So just go ahead and find 348. And I'm just going to draw the line because I actually, well, let's use the cursor first. Let's use the cursor. So to the upside, it's going to be 345, which is right about there. Isn't that kind of interesting? Look at that, guys. Let me move my cursor over here. 345 right at that resistance. And then 290. I'll be surprised if it's right not at it. No, it isn't. Okay, right about there. That's pretty close. So we're close. Let me get a darker line so you guys can see it. So there's their upper target right around there and the lower target right around here. So then you take a look at it and literally just make the decision if this is worth putting your money at. Now, folks, this is $2,700 completely. You're risking about half of that, about 11, maybe 12. We saw if we went to that blue line, maybe about 15, 16, right? So if it all goes awry. Now, the idea is that it can get to somewhere here and make an adjustment. If that can happen, or even somewhere here, let's say it just doesn't quite make it, and you make that adjustment quickly, folks, you're not going to take that $1,100 risk. It'll probably be much, much smaller because you're compensating with the volatility crush with the indeed directional move of the stock. Now, yeah, sure, it's not in this area, but it's going to be close. So the loss would be $300-400, not 11, not 18, so on and so forth. So keep that in the back of your mind. But please do not position size with that in mind, as you're going to get smoked. All right, so that is our first case scenario. Now, a couple things. Let's talk about the trade management, okay? What you can do by putting out that money, let me get my pen back out, is let's say this thing gaps up to, the 345 mark. If it hits the 345, you can close the whole thing and you will have a gain at that point. Anything above that should continue to gain. In fact, if we don't know, let's just take a look at our risk graph. I have to bounce back between the pen and the pointer. So let's take a look at it. So anywhere past, let's go back to without the volatility crush. Let's just go expiration with no day step. No, I think it's this one, isn't it? No. There we go. Okay, so let's go 2 days past. 1, 2, or rather, I was already there. Sorry, guys. The first. And this is the expected move it's going to be at. No, I need my day steps. Sorry, guys. I was right the first time. There it is. Okay. There we go. Okay, so now we can take a look at expected move. Okay, let's say this thing jumps up to our break-even cost of 345. Put the cursor over the 345. I knew I forgot to do something, and that's to find out what we can make. Now, if this happens today, we make $930. You guys can see the purple, the purple number on the bottom left of the chart. I'm hoping you're looking at that. The third, I'm going to drop this down because we don't have the availability for the second as well. Okay, the first. Let's go here. So the first, which is the red line, you can see in the red column, about $800. If it did that today, we make $917. Understand, it's going to be right in between those two. The reason being is because it announces tonight, the bell rings the 31st, and then we have the first. We don't have that because I did a 2-day skip. I guess if I wanted to, I could do it 1 day, get a little bit more focused. And one thing we have to take in consideration is that volatility crush. This is just if the price goes up. Let's see if it goes down to our 290 mark. Put it right on the 290 mark. Looks like we're looking at about 677 tomorrow and then 624 if it doesn't go any higher the day after that. So it's good. There's money to be made at our break-even points. So this one does work. Now, management-wise, let's go back to the chart here. If I can jump back to it. Management-wise, if it gaps up, sell the whole thing. Actually, you know what? Let's not even do it. Let's go to here. I'm looking at this bottom part. If it goes up after 3 days, we could just dump the whole combo, whether it's up, down, or sideways. Once the combo is profitable by up or down 10%, and it looks like it would be, even at the break-evens based on our cost. Actually 10%. Yeah, so have to be over $270, right? Because that's our total cost, not just the risk. I want it above the total cost of the trade. I was looking at what $500, $600 to the upside, about $500-600 on the downside. So that exceeds that. We can close the combo. Now, since we're 3 weeks out, we could also cut the calls if it gaps down and ride the puts further with protective stops. We could cut the puts and ride the calls further after the initial move. It has to move. Once it moves, you make your adjustments and you could ride it up. There's your management skills. Now, very quickly, guys, I really wanted to do this with you. Let's see if I can't get rid of all this. And let's take a look at another scenario. Oops, I didn't need to erase those because we're still doing Lulu. There we go. That all saves weight, but we're going to switch a couple of these out. Well, this works, this works. Buy to close the strike prices. And we're going to switch this bad boy to expiration date of, let's see, April 1st, /1. And I have to say April 1st because the 2nd the markets are closed, right? So 3 days passed, 0 days passed. Time frame tomorrow. Entry still the same. Targets are, well, we got to redo all those because we're going to have a new cost. Now, what you're going to find here, guys, is there's going to be some real good benefits to this. And it's mostly, guys, going to be in the cost. A lot of you guys are going to say, well, the risk reward is great and so on and so forth. The gambler in you is just going to get all sort of itchy. But that's a good sign. It's okay. So let's take a look at it. Let's go to simulator trades here. First of all, I'm going to kill this bad boy here that we were working on. And let's go straight to tomorrow. Now, one thing that's kind of crazy about that's 85% volatility. The volatility is almost double. Well, not quite. It's a lot. It's a lot more than even the previous months. We were looking at 50% volatility. This is about an 80% on top of that, so at 85.93%. But it's only got a plus minus of $19, so we don't have to have this move 27 bucks up or down to get to technical break-even points. So let's just quit yapping about it and let's build it. I'm going to go ahead and buy the puts. I'm going to go ahead and buy the calls. Make sure it says straddle down there. Drop this bad boy down to $2 or one contract. And let's take a look at the risk profile on this. First, what I want to do is take a look at expiration day step. There we go. So this is the basic, right? We know that when this expires, our max cost loss is going to be $19.65. Once again, options at the money straddle price the exact expected move for its expiration cycle. Kind of funny how that works. We knew that was there. I'm going to call this 20 bucks. So what's way cool about that, it makes the break evens much easier. Let's add some day steps. Oh, this is going to be hard to do. Oh, I got it. Okay, that was lucky because we're at day step 1. We only have 2 days on this, guys. Okay, so let's get to the upper break even. 217.50 plus 20 bucks is 237.50. Just hover my mouse right over that. There. Now take a look at the purple box. Probably not going to happen. 685 because that's going to be today. Tomorrow, 433. Okay, it's not 770 bucks what we're expecting on the other one, but we're not putting up 2,700 to buy it, are we? Okay, let's take a look at the downside, and I'm going to definitely. Oh no, I don't need that. Should be 297.50, right? Let's see. It's about there. $339. So it's not too bad. So 400 bucks, 450, 400 and change the upside, 350 to the downside roughly. Now that's just if it gaps up or down. Here's the catch. We have to be out. When that bell rings in the morning, you better be selling to close this bad boy at a limit for both the call and the put, because the volatility crush will absolutely destroy this very, very quickly. In fact, let's move to the steps. And let's see here. Let's just, our 10% increments. So let's say that it gapped up to the 335.50. Right about there. Now take a look at the 335.50 with a 20% drop in volatility. Our $450 gain is 373. With a 30% volatility crush, remember I'm saying the $440 gain because that's what it was just price, is now 211. That's the pink line. So you can see we don't want to be in this at all. So it's easier to do. It's just gap up, get out of the whole thing, gap down, get out of the whole thing. And then what you'll do, it's funny, I like to do this, when the smoke clears, you either have a profit or you don't. So I won't take the time to go through it, but if you wanted to, or make sure that you put it all in here, right? No stops, target. We could change a few things here. Let me get the little drawing tool and kind of amend this. So, by the 2 weeks out, it'll be pretty much the day of. Everything else, high beta, high shares, that's good. Looks like we got this correct. Quantity, all that's good. But if after 3 days, right out, there's no time. Tomorrow, change something. Price, once the combo is profitable by 10%, implement it. You can get rid of that because regardless of where the price is, get out. Right? And then you can calculate your max gain, max loss. Substantially cheaper, right? Almost $1,000 cheaper, almost 30%. So, but the gain was about half, about 50% when it came to dollar amounts. So keep that in mind. All right. So I didn't get too deep into that, but once again, as you can see, folks, the best way to learn these is to play with them. Go out and do a ton of these. I like to play earnings, not just with the straddle and the strangle, but the ratio spreads are kind of cool. Sometimes out of the money vertical spreads. Before I get a billion questions, guys, it's all in the advanced concepts when you get there. So enjoy, have fun. Thanks for joining me. If you got any questions, reach out and we'll talk to you next time. Bye, everyone.